Lesson 4. The secrets of indicators and oscillators revealed. Here is the big secret to oscillators and trend-following indicators. They cannot be used at the same time. If you use a trend-following indicator when the market is not trending, you will get many false signals. Conversely, if like many traders you are fond of using one or two of the most popular oscillators like stochastic or Williams percentage R, and you don't differentiate if the market is trending, you'll be extremely frustrated. You'll be wondering, why is it that this oscillator works so well every time I check it, but just when I decide to take its signal, it doesn't work anymore? We hear that type of complaint on a regular basis. So why is that? Because of this big secret to oscillators. They represent momentum trends, not price trends. Therefore, you should never expect a price reversal when an oscillator changes direction. This is something you should commit to memory. Price and momentum may not trade in the same direction. In fact, they often diverge. Unfortunately, traders are not aware of these two indicators' secrets that can make a huge difference in their bank accounts. So let me show you some examples. This is a daily chart of the ES with a MACD study during a non-trending period. If you are not familiar with MACD, basically it stands for Moving Average Convergence Divergence. The primary method for interpreting buy signals with MACD is when the shorter-term period moving average, which in this case is the blue line, crosses above the longer-term period moving average, in this case that would be the orange line. Notice how all three MACD buy signals marked with the vertical lines on the chart led to a big decline. The market moved precisely in the opposite direction than the indicator suggested. If MACD were the only indicator we use in our trading decisions, we would be buying the market with these three signals, and of course, we would have had major losses 3 times in a row. After a few of these times, which can happen often, we would conclude that indicators don't work, or at least that MACD doesn't work, and we will rapidly replace it. Now let's look at the same chart, but with the stochastic indicator. The vertical lines are in the exact same position, but instead of giving us buy signals like the MACD did, the stochastic gives sell signals, which all led to very profitable trades. If we were using stochastic during this phase of the market, we would be extremely happy and probably confirming that MACD is useless. But the reality is that in the first example with MACD, we took signals from a trend-following indicator when the market was in a non-trending period. That always results in false signals. When we applied an oscillator instead, we receive very profitable signals. The conclusion is not that stochastic is a better indicator, but you can rightly conclude that if the market that you want to participate in is trading sideways, your best bet is to use an oscillator. Just keep in mind that in top, we want to trade with the trend and avoid as much as possible markets that are trading within a range, a consolidation period, a non-trending phase. So let's look at the opposite example so you can see that stochastic is not precisely a better indicator than MACD. So look at this chart. It's also a daily chart of the ES during a more trending period, clearly identified by the slope of the two trend lines. Notice how the stochastic gives a sell signal by positioning in the overbought area and the crossing of percentage K, the blue line, over percentage D. Also notice how price continues to advance while stochastic remains in the overbought area for an entire month of trading. If we didn't know better, we could conclude here that stochastic is not a good indicator, right? Now let's see the exact same spot with a trend-following indicator. So here, notice how the MACD gives a rather beautiful buy signal that could be worth thousands of dollars. Again, not knowing the difference between oscillators and trend-following indicators and when the appropriate time to use them is, we will get frustrated and disregard a fantastic tool. These are good examples to show you why it is so important to develop your analytical skills. Without being able to properly identify the trend, you're not going to be able to decide what indicator is the most appropriate one to use at a particular time. Fortunately, you already know at least one quick way to decide. Look at the slope of your moving average. If it is up or down, the market is trending, and it requires the use of a trend-following indicator to time your entries. If the moving average is flat, then an oscillator will be the appropriate choice. This knowledge is key, and it is indeed the first step in our dual-frame top strategy. In a future video, we will discuss the use of MACD and an oscillator as DFTS variations.